Hello and thank you for joining us today. My name is Wesley Boudreaux, one of the ExxonMobil focused advisors here at the Retirement Group. Today we're going to talk about the ExxonMobil pension plan, give you a little bit of a history as far as how it operates, and talk about the interest rates used to run the lump sum calculations and how those are changing for the third quarter versus fourth quarter of 2023 and potential changes beyond that as well. Before I get started, just a quick reminder, even though we've worked extensively with ExxonMobil, that does not mean we're employed by them nor endorsed by them. However, again, our advisors have worked for quite a long time helping ExxonMobil employees retire and transition into retirement. And by doing so, we've got a deep understanding of the benefits plans, whether it be the pension plan, the 401k, healthcare, retiree medical, things like that and stuff. Also, throughout the course of this webinar, we'll have some information on the screen for you. There is a chat box where we'll put some links to follow along, items like how to follow us on LinkedIn, where to schedule an appointment with myself or one of the other advisors, maybe a questionnaire to ask us how this went or any other topics you'd like to add to it as well. And there's also the Q&A box. So if you do have any questions, feel free to put that in there. We'll be sure to try and get to as many as we can by the end of this. But if we fall short on time, we'll try and follow up with you to answer those questions as well. And your name is anonymous, so don't put your name in the question, but go ahead and put that question in there and nobody will see your name, and we'll get through as many of those as we can. So for a quick recap, for those of you who do not know who we are or haven't sat down with one of our advisors in a while, again, the Retirement Group, we are an independent financial advisory firm that focuses on working with Fortune 500 companies, ExxonMobil obviously being one of those companies we do a lot of work with. We've been doing this for a little bit over 30 years, and a lot of times our advisors will focus on maybe 3 or 4 different companies. So again, we have a deeper understanding of your specific benefits plans. And like I said before, this really is helpful on transitioning into retirement and letting you understand the best way to transition, the best way to maximize any benefits you get from ExxonMobil in this case as well. So again, it comes into the conversation we'll talk about today, like the pension plan, annuities versus lump sums, when's the best day to retire in order to maximize those options. Also, we go over the 401k plan, talk about the allocation, talk about NUA treatments, after-tax to Roth rollovers, things like that we can cover. And then also the retiree medical benefits you might see, as well as the life insurance, whether you want to keep that or not, and go through all those different options. Now, we do have offices throughout the country, so rest assured, if you need to sit down with somebody face-to-face, we can probably still accommodate that, but obviously this day and age, especially post-pandemic, it's very easy to have a web meeting, phone call, email, whatever your preferred communication is, just let us know. We'll be happy to honor that for you. And at the end of the day, if there's anything you take us up on, it's to run a complimentary cash flow analysis. This is actually a detailed financial plan specific to your ExxonMobil benefits. And if you've done one with us in the past, that's great. But if it's been probably over a year, we should probably update it, given a lot of changes over the last year with interest rates and the market as well. So we just kind of make sure that nothing major has changed in your specific situation. But by going through this, it can help us help you kind of visualize what your retirement would look like and what the next 10, 20, 30, even 40 years may bring for you, and help you determine the best day to retire. You might come to us and say, I'm thinking about retiring at 65, but gosh, we got a couple grandkids. I want to spend more time with them. Can I afford to retire earlier, 62, for instance? We can run those numbers and show those to you side by side, show you how they play out. And yes, at the end of the day, you might have a little bit less to pass on, but again, you'll have 3 more years of potential retirement versus work. Or on the flip side, it could be that we run the numbers, you're expecting to retire at 60, and we look at it and we're going to come back and we're not going to shy away from telling you, hey, you may need to work another year or 2. But what it really comes down to is that for ExxonMobil, it helps us on that pension plan show you the differences, which we'll go over today, between the annuity and the lump sum and the claiming options, whether you're looking to do 100% one or the other or break those up and how those play out and how it plays out on the timing aspect of it as well. So quick recap as far as what you're going to potentially see as your sources of income in retirement. That paycheck's gone. So what you'll be looking at is, depending upon when you decide to elect Social Security, you'll have Social Security. You'll have your 401k plan, which is a defined contribution plan you've made contributions to, and ExxonMobil has matched for pretty much every year except for that one in 2020. And then you've got the pension plan as well. Social Security, we can go through a full Social Security analysis if you want to go through that. But typical claiming is going to be between 62 and age 70. Full retirement age is going to be 66 and change to 67 for most people. and each year you wait and defer. If you defer out till 70, you get a raise, essentially an 8% bump on there. If you take it earlier, you get a reduction. But also, if you're married, it becomes a claiming strategy to look at. So we can go through all those with you, help you determine the best claiming strategy at looking at various life expectancy models and things of that nature in your specific situation. On the 401k, like I said, that's going to be where you've put in money over the years, and the contribution is what's defined. It's a defined contribution plan. The outcome's not. So again, you could have invested all in common assets and seen it grow steadily, or you could have invested in different indexes or ExxonMobil and seen fluctuations. So again, the contribution is defined, the outcome is not. So once you do retire, you can maintain that at the 401k through Voya, or you can roll over to an IRA where you have more flexibility with your distribution options and definitely more flexibility with your investment options, whether you do things on your own or work with a company like the retirement group. And so then your distributions are what's going to fuel your retirement on top of your pension. So your pension, you could take the annuity. We'll go through those different options where it's an income payment for life, or you could take that lump sum and roll that over into your 401k or into your IRA we just talked about for, again, more flexibility and different withdrawal strategies to make sure you're not just taking care of yourself, but your beneficiaries and your potential legacy as well. So let's dig into the pension plan. The pension plan at ExxonMobil is still a classic defined benefit plan. It's not a cash balance plan. When I say classic defined benefit plan, it's uses a formula in order to get to that. And I'm jumping ahead. We'll go through the formula next slide. But what's going to happen is it's going to come out to a single life annuity is what that calculation gives you. Everything else is calculated from that. So let's assume we run through the calculations and it comes out that you're going to get $4,000 a month for the rest of your life. Now we'll talk a little bit later about how much of that $4,000 you'll get depending upon your age, because there could be some age penalties if you retire earlier than the normal retirement age. And then at that point, if you were just taking that single life annuity, then yes, that $4,000 is what you'll get for as long as you live. But you could deviate from that. You could say, well, gosh, I'm married. I want to make sure my spouse is covered. So you might do a joint survivor annuity so that he or she gets paid out in case something happens to you. And those can be at different levels, 25, 50, 75, or 100%. So instead of paying $4,000 a month, Exxon's not going to give you $4,000. They'll give you something lower because they're paying off of 2 lives. So there's a higher risk of them paying longer in that scenario. Or it could be that you want to do a period certain. You want to have a 10, 15, or 20-year period certain, so you're assured of a certain amount that's coming back to you. Even if you pass away early, that's going to go to your beneficiaries. And you can do that in conjunction with a joint survivor annuity as well. So those are some different ways to make sure that at least the amount you've built up in your pension is protected to an extent. The other option, which we'll talk about with interest rates, is a lump sum. If you say, okay, I don't want the annuity, I don't need the income, or maybe I've got fears of inflation pressure or longevity issues, so I want to take that money and run, and I want to invest it or manage it myself. There's a lot of different options. You can take that money, manage it yourself. Hopefully you do well, and hopefully you don't have any spending issues. That's the biggest risk we see, is people spending through those assets too quickly or mismanagement issues. So that's where it's good to work with a firm like the retirement group or even someone else, just as long as you've got somebody who's watching out for you and understands the withdrawal rates and factors that go into retirement planning and helping you through that process. But at the end of the day, you're able to take that pension lump sum, roll that over into either the Voya 401k plan, or you can roll it over into your IRA. And then what you do with it from there is going to be your decision. Again, working on your own or working with a firm like us. You could also turn around and say, well, maybe I like the idea of the annuity, but maybe I don't want it from ExxonMobil because I don't want that fixed amount. I want some inflationary adjustments or things like that, or more flexibility for my beneficiaries if something happens to me. Then you can go in there and buy your own annuity as well, but that gets into more of a one-on-one situation to talk about. So we'll get to the rates in just a moment, but the interest rates they use after that calculation is done to figure out what your lump sum is going to be depends upon how old you are. You're either grandfathered under the GAT rate, or you've got the PPA segment rates, which came out in 2008, and I'll go through that when we get to the rate chart here in just a moment. So that formula I mentioned, I jumped the gun here. That formula, in order to determine what that single life annuity is going to be, is they look at your years of service. So it's 1.6% times your years of service times your final average pay minus the Social Security offset. So what that means is ExxonMobil's been paying half your Social Security taxes as you've been an employee. So they're clawing that back out in that formula that they go through there. And that final average pay, it's actually going to be your highest 36 consecutive months over the last 10 years of your career. So for some of the guys and gals that are in the refinery, for instance, if you had a year and a half or 2 years that you work turnaround or a lot of overtime, that could be captured in there. We've worked with a lot of individuals that decide to go work overseas the last couple of years before retirement, so they can pad those numbers as well. So those are all conversations we can have and making sure you understand those. We have actually seen in some cases where individuals worked overseas and kind of got burnt out and came back and did something that was different, took a pay cut. And if they and we were at a point where they were getting close to that 10-year mark, where actually if they hung on a little bit longer, then that old overseas from 10 from 8, 9, 10 years ago was going to drop off. So again, depending upon if you've had any major changes in your spending, that's something to look at. And it's also good to dig into the Social Security offset as well, especially if you didn't work for ExxonMobil before, because there could be some errors there, in which case we can submit those and actually get you a higher calculation for your annuity or your lump sum. So let's talk about the retirement as far as how much of this potential pension are you going to actually get. So the one thing I need you to remember, just everybody at Exxon needs to remember the back of their mind, is going to be 55 plus 15. I need to make it to age 55 and have 15 years of service, because that's what qualifies me as a retiree and not a terminee. And there's a lot better treatment for a retiree than what there is a terminee. Now again, that doesn't mean you're terminated, you can walk out, but they just call you a terminee if you don't have 55 plus 15. So 55 plus 15, if you retire at 60, that's your normal retirement age. If you go earlier than that, there are some reductions, and we'll go through those shortly. But for somebody who's a terminee, doesn't have the 15 years and isn't in there, you're going to have to look at 65 as your normal retirement age in order to get 100% of your pension. So you could have come from a different company and come over to Exxon at age 60, at age 62. You work 3 years, and then you're going to be 100% eligible for your pension. Maybe you came over at 57. You're looking at 7 years to get to that. Otherwise, you would be considered. Otherwise, you wouldn't get all of it, and the terminee schedules are a little bit different than what you're going to see for a retiree. So for retiree, that breakdown is very easy to calculate. It's simply just 5% per year that you go before age 60. So if somebody said, hey, I'm going to go and I'm going to retire at age 57, so they're 3 years shy. So instead of getting 100% of their pension, if they decide to elect it and commence it at retirement at 57, they're going to get 85% of what that actual pension is going to be. Now, somebody could retire at 57 and they could elect to defer their pension until age 60, so they age out of those penalties. And we've worked with a lot of people where we've looked at situations, especially in the past during the pandemic when interest rates were on the decline, where we told people that, yes, if you're retiring now, it's great, but let's hold off and look at this quarter by quarter. Interest rates are on the decline. Every quarter we wait, you might get a good bump in your lump sum. So it's really important to understand that as well. In which case, if the interest rates are declining, it's perfect because you're getting a bump based upon the interest rates in the lump sum calculation. Also, you're aging out of that 5% reduction. And that 5% is not a cliff. It's not 5% flat every year. It's going to be prorated, so if you've got, 2 months out of the year or 10 months out of the year, whatever it is, they're going to give you the prorated amount and figure out that percentage. And then, and God forbid, if you had disability, you could go earlier at 50 or so. But again, those numbers changed. And I don't think we have it on this webinar. But if you're a terminee, the cuts are about twice as much, if you would. So somebody that was a terminee at 57 versus retiree, instead of getting 85%, they might get closer to about 45, 50% or so. But we have those charts if you need to go through those. Again, the other issue as far as a terminee versus a retiree, the terminee does not actually get that lump sum option historically. Now, what's happened is there have been a couple instances here in the last 2 years where Exxon has gone to past terminees and elected to potentially buy out their pension plan with a lump sum. So you may have seen that offer. That's a one-time offer. We don't know how long that could continue. And we've also seen the last year or two where some terminees were given that option for the lump sum. But historically speaking, and based upon the plan documents, the terminee does not have the lump sum option. They only have the annuity option. So again, it's the age penalties, the time to get 100% of pension, and the options for the lump sum that you may not have as a terminee. So we talked about a lot of it, but let's get into the actual interest rates. And I think that's what a lot of people always are kind of looking at and concerned about as far as the decision to retire and when to retire from ExxonMobil. and whether they're going to take that lump sum or not. I'll be honest with you. If our conversations the last 3, 4, 5 years, really 3 years, has been I'd say 95% people were leaning towards the lump sum just simply because we had very low interest rates, which when we have low interest rates correlates to a higher lump sum. So we take a look at the seesaw here at the top of this chart. When interest rates go down, your lump sum is going to go up, and the vice versa happens. When interest rates go up, which we've seen here recently, your lump sum is going to go down. The reason that is because the way they calculate it, they actually use that interest rate to calculate a net present value of what your payment's going to be. So if somebody, going back to that hypothetical example I gave you before, somebody retires and they're getting $4,000 a month for the rest of their life, what they'll do is they'll go and look at, okay, how old is this person? What are life expectancies? So let's just say the person is 60 and life expectancy is 86. They'll say, okay, well, we've got to pay this person on average for 26 more years. So what's the current interest rate we're going to use? And we do a net present value calculation to find that out. So if somebody's older, let's say that they're, instead of 60, they're already 66, so it's only 20 years. So the older you are, the less those interest rates are going to affect you. But those interest rate changes, usually about a 1% change equals roughly about an 8 to 12% change in your lump sum calculation. So again, it's really important to understand that and know that. And the interest rates are going to be different for different people. For, I would say, a large percentage of you, you're under the PPA segment rates now, which they changed back in 2008. But what happened is if you're older than 65, or if you were 65 with 25 years of service by the end of last year, so the end of 2022, then you're grandfathered under the GAT rate. And that's what's going to be on the far right-hand column here. The GAT rate's going to be a lower rate because it's tied to the 30-year Treasury times 95%. So it's the average of the 30-year Treasury from the prior quarter. And so we can see right here for both the third quarter and the fourth quarter, it's actually going to be 3.5%. I'll zoom in here in just a second to look at some of these. But before I do that, let's go ahead and talk about if you're not grandfathered, which most people aren't. That's going to be under the PPA segment rate, so the Pension Protection Act segment rates, which are going to actually be, instead of one interest rate, 3 different interest rates they use. There's the first, second, and third segment. These are more closely tied to corporate bond rates, but the first segment is going to be for the first 5 years of retirement. Second segment can be for years 6 through 20, and the third segment, years 21 and beyond. So for most of us, that second segment is going to have the highest weighting because it covers 15 years of retirement. So somebody that's retiring with 30-year life expectancy, that's covering half of their retirement. Somebody with 25-year life expectancy is covered 60 some odd percent or so, maybe closer to 70% of their retirement. So again, there's a higher weighting on that middle segment. So we tend to look at that and track that more often. And what they do is they go back from the prior quarter, look at the last 2 months average of those. So we just got out, usually the Fed releases those about the third week of the following month. So towards the end of July, we got that information of what June was. So with the May and June, that's going to give us what fourth quarter is. Previously, February and March is what gave us for third quarter. And once we get August and September, we'll know what the first quarter is for 2024. But one of the things you'll see here is the interest rates actually are not that much different from the third quarter to the fourth quarter. There was a slight uptick across the board. What we actually saw was interest rates kind of, they were low, quite a bit lower during the pandemic. We knew they were coming up last year. They came up a little bit more dramatically and more sharply than we expected. But those interest rate rises, cost a lot of people that hung on, 15, 20, 25% drop in their pension lump sum. But again, this is a moot point now. We're past that. So the question becomes, if I'm taking the lump sum, again, this only bothers you if you're taking the lump sum. If you're taking the annuity, these interest rates don't have any effect. But if I'm taking that lump sum, what am I going to be doing, or what are the options going forward, and how these interest rates look? So let's go ahead and zoom in here and take a look at that. The first, second, and third segments. So for Q3, so the second row in that the blue is going to be 5%, 5.16%, and 5.06%. And we move up to the first line for the fourth quarter. We're coming up a bit across the board at 5.09%, 5.19%, and 5.25%. So again, we talked about 1% equaling 10%. This isn't a big jump. It's going to have a minute effect on third quarter to fourth quarter. You might see less than a 1% drop potentially in your lump sum, but we can run those pension estimates to show you exactly what it is. So for most of you, whatever that drop is, you might make that up in income. So we'll have to keep a lookout on what we're looking for the first quarter of next year. If we go back, we're kind of at the peak or at the historical highs for these PPA segment rates. October we peaked out at about 5.83%, that middle segment. We have to go all the way back to 2009 to get something higher than that at 5.95%. And so since that October, we've actually come down a bit into the high fours and kind of peaked back up now, looking at that 5.23 here for June. So we'll see how things go forward, but we're towards the high end of that historical average, or above this historical average, but close to the highs we had back in 2009 or so. If we do see those start to drop, then again, that first quarter could have lower interest rates and it could rise your lump sum calculation there. Another thing, I think it might have been on a previous slide before I wrap up, I just want to mention that I may have skipped over, is again, the interest rates are only affecting your lump sum, and you may not take the lump sum at all, or you may take a combination. ExxonMobil did change this in 2015, give the option to take an either or, that either the annuity or the lump sum, which most companies do, but they also added a feature of a split option where you can split it 50-50 or 75-25, 25-75, whichever way you want to go. So again, when we run those cash flow reports, the cash flow analysis, that's something we can run side by side to show you all the different options, whether I take the lump sum, whether I take the annuity, whether I do 50-50, 75-25, however it makes sense. We can run through all those to show you what those options are. But usually at the end of the day, most advisors are going to recommend that, whether it be Social Security or maybe a portion of an annuity, through the company or outside the company, you want to make sure at least your essential expenses are covered in that aspect for your essential spending. Discretionary spending, you can look at more flexibility with an IRA or your 401k in there as well. But when you have time, just give us a call. We can schedule a meeting to go through that cash flow analysis. Right now, about 3/4 of Americans over 50 don't have one. That's again a financial plan. Give us about 10 to 15 minutes gathering some data from you. Give us about a week to put that together, and then we can go through that in detail, show you where you stand, and we can run some tweaks from there if you want to see any alternative options as well, and make some changes to it. But again, I want to wrap this up. This again was talking about the pension, but if you have any other questions about anything else Exxon related, whether it be the 401k or retiree benefits, you can call us as well. We got a couple QR codes here on the screen. You can go ahead and use one of those to get in to our calendars, schedule an appointment with myself or one of the other ExxonMobil focused advisors. Those calendars, usually that QR code gets you about a week out, so if you need something sooner, if it's urgent, just give us a call or email us. There's also a QR code for our LinkedIn plan, our LinkedIn access, so you can follow us on LinkedIn, not just the retirement group in general, but also get updates on our ExxonMobil specific stuff, whether it be the quarterly updates on interest rates, changes to the plans, things like that. And then always give us a call at 800-900-5867, or you could also reach us at info@theretirementgroup.com as far as emailing. I know we'll wrap this up. I know we got some questions here. I'll go through about 3 of them here, and if we have any more, we'll follow up with those. But let me get to those and get you guys on your way. Okay, so first one. I'm retiring this year and considering the annuity. With rates higher, is it better to take the ExxonMobil annuity or take the lump sum and buy an annuity with that lump sum myself? So this is actually something that, the last 10 years wasn't really an option. Because the way interest rates were, with the interest rates lower, if you were to take that lump sum and go out and buy your own annuity, depending upon the kind you bought, most of them weren't paying that much because the interest rates were low. Now last year was an incredible sweet spot for actually doing something like this, where we helped a lot of people do this, where they might have been inclined to the annuity, but we ran the numbers and said, okay, well, ExxonMobil is going to pay you, $4,500 a month for the rest of your life. But you could take this lump sum, go out and buy your own annuity or various annuities if you want to split it up, and get, it might have come out to $4,800 or even $5,000 a month for the rest of your life. Well, so there's some significant increases, and a kicker on that was, instead of if something happened to you, let's say shortly in 10 years or 15 years or 20 years, instead of ExxonMobil keeping it, you can structure those so you have a cash refund on it, or make sure your beneficiaries get back out what you got out of that lump sum, so you can essentially lock that in. That can still be done right now. It's not as lucrative, but it's always worth at least reviewing and looking at those side by side. So when I said, again, we run that cash flow analysis, look at all those options, that's one where we can dig into there if you're thinking about the annuity. So again, a lot of times it may even come out that a private annuity may not pay as much, or it may just pay a little bit more, but it could provide more flexibility as far as inflationary adjustment options in there, or better beneficiary treatment. So if you are retiring this year and you're trying to go through that and you haven't done so yet, give me a call. We can go through that and run some calculations for you, and at least just let you know what the options are for you at this time. Okay. In my pension formula at Exxon, I have an offset for Social Security, and my Social Security looks low. Will this hurt my pension? I mentioned it a little bit. There's a Social Security offset in there. So essentially what happens is ExxonMobil claws back the amount they've been putting in for Social Security. In this question where it says, my Social Security looks low, will that hurt me? Actually, the opposite. If your Social Security looks low, then that's a good thing, because what's going to happen is, again, that Social Security offset is a minus, so that's a negative to you. So if that comes out and ExxonMobil has a calculation that's lower than what your actual Social Security is going to be, and most of the time that's going to be a case. It's not going to be a huge difference, but it is going to look lower. Then keep that. Don't do anything about that, because that's a benefit to you. It's the flip side that can hurt you. An example would be if somebody didn't work for ExxonMobil their entire career, especially if they worked in the public sector. Maybe they were a teacher for 10 years or something, or worked in a government position and then came over. What's going to happen is Exxon's just going to take a look at your pay that they're giving you and kind of backdate that and assume you've had that for the 40 quarters when they run that estimate. So it might come out and say that Exxon's assuming that your Social Security is going to be $1,800 a month when they run the offset. But if you go out there and you've actually got a Social Security estimate from the Social Security website that shows instead of $1,800 a month, it's actually, let's say, $1,200 a month, then we can submit that to HR and get them to update that and manually change the Social Security offset. And what that will do is that will change the calculation and for a benefit for you. And we've seen this in cases where it's bumped up the annuity payments by $100, $150 a month. In some cases, bumped up the lump sums by 50 grand or more. But it's very important to know that once you submit that to them, they use that. So you want to make sure, again, that it's something that your Social Security, your actual Social Security estimate is lower than their estimate. So again, if they're estimating lower, that's a good thing, not a bad thing. If they're estimating higher, that's a bad thing. But give us a call before you do this, because once you do it, it's not you can't reverse it. Okay, I get one more here, and then we'll follow up. So this person, I'm a grandfathered employee. How will that affect my lump sum in regards to interest rates? Are they increasing for my rates as well? Okay, so we went on that breakdown. I gave you the grandfathered employees. That's somebody who is 65 with 25 years or more of experience, of being on the books with ExxonMobil at the end of 2022. So if you are grandfathered, that's going to be the GAT rate, which again is going to be the 30-year Treasury times 95%, so a lower interest rate. For third quarter, fourth quarter, there's really no change there. It's 3.5%. The actual averages came out to like just above, like maybe 3.54%, I think is what it was for third quarter. So round it down, that would be 3.5. For fourth quarter, I want to say it was around like 3.61 or something like that. So we should be looking at them round that down to 3.5. It's not official yet. They can go in either direction they want, but historically they should go down to 3.5. However, looking at it right now, just through the end of July, we look at the averages, it's up closer to about 3.75. So if we stayed where we are right now, we could see a bump up to that 3.75 mark for Q1 of 2024. So that could hurt you. That could go up at that point. If they come down a bit and level off, it could stay at 3.5. If they go higher, we could jump through the 3.75 and get up to 4%, which would be one of the highest we've seen in some time. So yes, those could hurt you. The beauty there, though, is you got a little bit more of a crystal ball as a grandfather employee, because we know what the interest rates all the way up to the end of the quarter. Whereas for the PPA segment rates, we don't know until they're released about 3 weeks after the end of the quarter. So again, good question. If you are grandfathered, then give us a call. We can run through that and double check those when we get closer to the end of the quarter for you as well. So with that, I know there are a few questions in there. If we didn't get to yours, I apologize. We will follow up with you. But again, any questions, just reach out, give us a call. Even though we've worked extensively with ExxonMobil, whether you're executive, working at the refinery, expat, we've gone through all of that. We can help you through those options and understanding the plans and how to transition into retirement. But even though we've done that extensively, does not mean we're employed by them nor endorsed by them. But should you have any questions on any of those benefits, just simply give us a call. Or if you want to review your 401k, or you've got questions on the retirement transition, we can go through that with you. Again, you can reach that 800-900 5867. Thank you very much. We hope everybody has a great day.